Very good morning, traders. Welcome to Tuesday's Market Tactics with Rohan. We'll be focusing on seven major assets today that include the dollar index, gold, crude oil, Aussie US dollar, USD JPY, the pound and the dollar, and the euro US dollar. So let's get into it right away. Recently, the US dollar index remained flat despite news of China's plans to issue a record 3 trillion yuan of special government bonds in 2025. Currently trading at around 108.11 in Asian markets, the index is close to a two-year high, driven by a 7% rise since September end. Factors contributing to this include expectations of accelerated US economic growth under President-elect Trump's policies and persistently high inflation, which has tempered market predictions for aggressive Federal Reserve rate cuts. These contrasts in growth prospects and interest rate policies between the US and other economies have widened the interest rate differential. This week, the DXY has traded in a narrow range and may end the year near its two-year high. Resistance levels include the December 28, 2023 trend line at 109, with further resistance at 109.29. July 14, 2022 peak, that is support levels are 107.6, recently turned from resistance and the psychological mark of 107. We'll look into crude oil now. On December 25, Thursday, the US crude oil was reported at $70 per barrel, returning to the vicinity of the central axis of the range oscillation. In 2024, the overall oil price showed a volatile downtrend. In the first quarter, oil prices rose unilaterally and reached the highest point of the year mainly due to OPEC plus production, positive production in the OPEC, cuts on the supply side. Geopolitically, the continued war between Russia and Ukraine and the escalation of the Israeli Palestinian conflict had driven oil prices up. Since the beginning of the year, OPEC positively has continued to implement production cuts, which has played a certain supporting role in oil prices. By the end of November market, supply expectations had stabilized, driven oil prices up. Subsequently, due to the cooling of geopolitical risks due to Israel's lack of substantial retaliation, weak supply and demand fundamentals, a decline in demand, and the OPEC meeting maintaining a production cut policy, oil prices have fluctuated and narrowed until now. In terms of recent technical trends, the short-term active key resistance is $70.75. That is also the 100-day moving average, and $71.46. That's the February 5th low. These act as a solid resistance level, and if more support for oil bull emerges, the next key levels will be $72.23. That's a 50% Fibonacci retracement zone from 77.93 to $66.53, and $72.54, that is the November 7th high. As for the downside, the 20-day moving average of $69.12 and 68.81, that is the December 17 low, are still the first solid support nearby. Let's move on to gold now. On Thursday, December 26, spot gold traded in a narrow range around 26.30 per ounce amid light market activity due to Christmas holidays. Geopolitical tensions and trade war concerns support gold's safe haven appeal, but the lack of strong follow-up buying limited its upward momentum. Rising US Treasury yields, which increase the opportunity cost of holding gold, weighed on its attractiveness. Strong USD performance and robust Treasury yields could further pressure gold prices. Although US financial markets reopened, many European markets remain closed, keeping overall trading volumes subdued. From a technical perspective, gold's recovery from a one-month low within an ascending channel has formed a bearish flag pattern. On the hourly chart and daily oscillators remain negative. This indicates a bearish outlook with the path of least resistance leaning downward. A decisive break below the channel support at 2605 to $2,600 is needed to confirm further depreciation, which could bring gold back to its monthly low of $2583. On the upside, the resistance lies in the 2633 to 2635 zone, with further hurdles between 2650 to 2670 zones in case of a rebound. Let's move on to Aussie now. So this week, the RBA December meeting minutes highlighted reduced upside inflation risks, reinforcing expectations of a rate cut in early 2025. This outlook, combined with concerns over China's fragile economic recovery and the US China trade war, pressured the Aussie dollar. The Aussie pair is trading in a narrow range above 0.62, near its lowest level since October 2022, and remains in a nearly 3 month downtrend. It's severely in a downtrend from the past 3 months. Market sentiment is further influenced by the Fed's hawkish stance, which supports the US dollar and limits Aussie dollar gains. The pair's modest rebound from the 2 year low is largely technical, following the 14-day relative strength index entering oversold territory. This rebound aligns with an ascending channel on the short-term chart, forming a bearish flag, indicating the path of least resistance remains downward. A move to the channel barrier near 0.63 could be viewed as a selling opportunity unless a strong breakout occurs, which may lead to short covering and push the pair toward the 0.634 to 0.6355 resistance zone. Conversely, a break below the channel's lower line around 0.623 may find initial support at 0.62, that's also the psychological level. A sustained breakdown below 0.62 could accelerate declines toward intermediate support at 0.613 and 0.612, and potentially challenge the 0.61 psychological level as well. Let's move on to the pound now. The pound is trading in a narrow range around 1.2530 with low volumes due to the post-Christmas holiday season and upcoming New Year holidays. The pair has been consolidating with limited price movements in a quiet market environment. Broader market sentiment favors a strong USD, supported by expectations of a slower pace of interest rate cuts by the Fed. This cautious outlook, influenced by a slower than expected decline in inflation and uncertainty about Donald Trump's policies, has been reinforced by Fed forecasts and the dot plot chart showing the federal fund rate potentially falling to 3.9% by the end of 2025, indicating fewer rate cuts than previously anticipated. The pound remains vulnerable after breaking below the rising trend line around 1.26, originating from the October 2023 low of 1.2035. The death cross formation between the 50-day and 200-day exponential moving averages near 1.2790 signals a strong long-term bearish trend. Additionally, the 14-day RSI has dropped below 40, indicating the potential for new downward momentum if it remains below these levels. On the downside, the pair may initially find support at 1.25, it's also a psychological level, and further at 1.2475, which is the 7 month low. On the upside, recovery to 1.26 or 1.2625 could signal a bullish reversal. The USD JPY pair has been extremely volatile in the past 2 months, and it is challenging the psychological level of the US dollar index at 108, maintaining its recent rebound. On Wednesday, Japan's draft fiscal plan revealed an unprecedented fiscal year budget of $734 billion, approximately 115.5 trillion yen, to address surging social security costs and rising debt repayment burdens. This move increases Japan's debt load, drawing domestic and international scrutiny. Compounding the situation, the Bank of Japan is gradually withdrawing from its decade long ultra low borrowing cost policy, creating new fiscal challenges as the government loses access to previously favorable financing conditions. The pair recently hit a near 5 month high of 158.08, with the 108 level acting as an immediate resistance point before the multi month high near 160. A sustained move higher could trigger bullish momentum supported by positive daily chart oscillators, potentially pushing the pair through the 158.45 barrier past 159 and toward the 160 psychological level. Conversely, a decline below 157 could find support at 156.65. A break below this level may lead to further weakness toward 156, though dips to 155.5 or 155, the psychological level, are likely to be seen as buying opportunities, limiting deeper declines. Talking about the euro, it has fluctuated in a narrow range of 1.04. The price action of the currency pair was flat due to the light trading volume on Wednesday and Thursday, due to the forex market holidays for Christmas and Boxing Day, respectively. The overall outlook for the pair is bearish. The euro weakened slightly at the beginning of the week after European Central Bank President Mr. Lagarde said in an interview with the Financial Times that the central bank was very close to declaring that inflation has reached its medium-term target of 2% sustainably. The ECB's dovish bets for 2025 continue as the market firmly expects Eurozone inflation to return to the bank's 2% target. Traders expect the ECB to cut its deposit facility rate by 25 basis points in the next four policy meetings. The pair remains below all short to long term EMAs and fluctuates around 1.04, remaining above the 2 year low of 1.0332. However, the outlook for Euro US dollar remains strongly bearish as all short to long term EMAs are declining. The 14-day RSI fluctuates in the bearish range of the negative 38 zone, indicating the presence of downward momentum. Looking down, the pair may fall to the support level of the round number mark of 1.03 after breaking the 2 year low of 1.0332. On the contrary, though, the 20-day moving average of 1.0477 and the psychological level of 1.05 will become the key obstacles for the euro bull. That's all for today's market analysis. With President-elect Trump's inauguration in the third week of January and several important economic events lined up post-holiday season, January is shaping up to be a highly volatile month. Stay informed, stay disciplined, and remember to manage your risk effectively, guys. Always remember it's a marathon, not a sprint. Thanks for watching. Thanks for staying tuned. We'll see you in the next update. Happy trading and best wishes from BCR. Thank you.